Hello, good evening, everybody. And thank you for joining this section this evening again. I think this is the fourth series in our IFRS refresher course for this year, 2025. And I believe it has been a great section for some of us that have been attending. Now, usual tradition, we wait for 5 minutes, then we'll start. Just waiting for one or two few latecomers that we might have. So just wait. It looks like maybe people are getting tired. Don't worry. This is the last of the fourth series. This is the last section. We're going to put it to close today. I'm sure maybe today's section will not be very long like the other sessions we had. All right, so thank you very much. And welcome to our last and final section for this series. And I hope it has been a very good use of our time. We have learned one thing or the other, and we have taken away some things from the course. Today, I will do a wrap up and we'll just touch one or two of those small standards and not too complex standards. I know the last week edition was very engaging. It was very deep and very technical, but we don't have that kind of task today, so don't be afraid. What we have are very regular accounting standard. So I'd like to welcome all of us, and just to also remind us, this is a free training section put together by PML Professional Services. We're a firm of chartered accountants, and we provide things that has to do with audits, tax, advices, and specialized software. A specialized software covers things that has to do with accounting software, governance, risk, and compliance solution. That's what we do as a business. And my name is Abiola Fajimi. I will facilitate mainly the section today, but I've been all the while I've been facilitating along with Babatunde Abimbola, but I will be anchoring the section this evening. Well, in terms of experience, I have about over 20 years experience now, providing things that has to do with audits, tax, trainings, and consulting services to companies, both in Nigeria and abroad. And I've also been privileged to have been implementing IFRS for the last 17 years thereabout. And also as part of that process, I've had the opportunity to create so many organizations on IFRS. So today is day 4 and our final day, maybe because this was a slide we were meant to take last week, but because of time, we could not get there. So we'll start with this slide and then move to the other slide we have for the day. But in terms of slide content for the day, we'll look at IAS 10 event after reporting period. We'll look at taxation. We'll look at statement of cash flow. We'll look at related parties and earnings per share. So these are the standards we want to look at today. A couple of them are short standard. So IFRS 13. The objective of these standards is to define what is fair value. If you can remember, and if you have been following, we've talked around measurement of some assets at fair value. So today we want to cover how do you really determine this fair value and what is really the fair value. So this standard provides a guidance or framework that should be used when determining what to consider as fair value. And it also sets a single IFRS framework for measuring the fair value. So it defines it, it set the framework for measuring it, and the disclosure that you need to make in respect of the fair value measurement. This standard applies only when there is another standard that requires or permits disclosure about the fair value. For you to use this standard, there must be another primary standard that requires you to measure that item on the fair value basis. So this standard is just explaining what another standard requires of you to do. So if a particular standard does not require of you to do fair value, then you cannot apply this standard. But the standard does not apply to share-based payment when people are being compensated with share of the organization. When companies is compensating employees with their shares, it's not applicable to share-based payment. It's not applicable to leasing transaction accounted for in accordance with IFRS 16. And it's not applicable to the net realizable value in IAS 2 inventory or value in use in IAS 36. If you have been part of this, you will remember the net realizable value in inventory and the value in use in IAS 36. So it's not applicable to all those ones. A fair value measurement is for a particular asset or liability Therefore, when you are measuring the fair value, analysis shall take into account the characteristics of the asset or liability. When you talk about fair value, it's for a particular asset or liability. And when you want to measure it, you need to consider the characteristics of that asset or liability in determining the fair value. And it's not just the characteristics. You need to consider the characteristics that those that deal in that instrument we consider when determining the pricing or liability at the measurement date. It's not just the characteristics. You need to consider the characteristics that the real market participant, people that buy and sell those assets, the characteristics that they will consider when making decisions about the pricing of such assets. Such characteristics include the conditions and location of the asset. They will consider the things like the conditions and location of the asset, restriction, if any, on the sale or use of that asset. If there is any restriction, if any, on the sale or use of that asset, all of this they will also consider. Then the transaction. A fair value measurement assumes that the asset is exchanged in an orderly transaction between the market participant to sell the asset or transfer the liability at the measurement date. It is assumed that when you are estimating the fair value of those assets, the fair value is being estimated or determined in an orderly transaction between the market participants. So it's assumed that this transaction is taking place on a very orderly manner. It is not being sold, for example, under duress. You are not being compelled. You are determining the fair value under normal situation, no pressure. And it will, at measurement date, the current market condition which will take place either in the absence of a practical market in the most advantageous market. And this last point is also very important, that in the absence of a principal market, you are allowed to value the instrument at the most advantageous market for the asset or liability. This is why, if you think about the concept of forced sales value versus market value, we know when the valuers value our assets, they always give us two numbers, forced sales value and the market value. This standard requires that you need to recognize the fair value for the most advantageous market, not just any market. The fair value is going to be based on the fair value for the most advantageous market. So if the instrument has two markets, the fair value you are going to use should be that of the most advantageous market for the asset. It is not the forced sales value you use. You will use the fair value of the market because that's the most advantageous for that instrument. What is the fair value? Fair value is the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction in the principal market at the measurement date under correct conditions, regardless of whether the price is directly observable or estimated using another valuation techniques. So that's how much you are willing to sell, you are willing to receive to sell the asset, or you are willing to pay to transfer the liability in a very orderly manner in the most advantageous market. Very orderly manner, meaning that you are not under pressure, it's organized, nobody is compelling you, and it's in the advantageous market, regardless of whether the price is directly observable or estimated using valuation techniques. You measure the fair value using the assumption that will be used by market participants when pricing the asset and liability, assuming the market participant act in the economic best interest. You are using all the assumptions that they use in that market to determine the fair value. Fair value at recognition, when an asset is acquired or a liability is assumed in an exchange transaction for that asset or liability, the transaction price is the price paid to acquire the asset or receive it to assume the liability. So when we were even dealing with financial asset, financial instrument, we spoke about fair value. That whatever is the consideration you have paid to acquire or receive that, to assume that liability, is your fair value. And for initial recognition, whatever is the consideration you've paid or received is accepted to be the fair value of that instrument, except when you can then establish that the transaction was not carried out in line with the standard conditions that will have been used by the market participant. And if you can remember, we pick things like staff loan, director's loan as example when we're even doing financial instruments. What kind of information do you disclose? Part of what is required of us is to disclose what we call the fair value hierarchy. And the fair value hierarchy shows the user of the financial statement how you have determined the fair value. It tells us the story of how you have arrived at the fair value you have disclosed in the financial statement. Level 1, you will classify your fair value into 3 levels. Level 1, level 2, and level 3. Level 1 is when the price is determined based on the price in an active market for identical asset or liability, which means for that instrument, there is a market and you have determined the fair value based on the pricing in an active market, in the market that is actively buying and selling that instrument. That's what you have used to determine the fair value of that instrument. Whatever instrument has been determined at that level is grouped together as level 1, and the total amount reported in the financial statement. Level 2 is when there's no market. The instrument in question does not have market, but there is a similar instrument that has market. And you've used the value of that similar asset to be able to determine the value of this instrument. You have done a comparable market price analysis. Even when I know that I don't have market price, I can compare my market price with market price of another instrument that is similar to my instrument and is actively traded. I can compare that value with it, and based on that, determine what is the fair value of that instrument. Then level 3 is when there is no observable market input. This instrument does not have any market. There is no comparable instrument that you can benchmark the fair value. So on your own, you work out what you think the fair value will be, and that's what we are going to use to determine the fair value for disclosure in the financial statement. Example of such model is if you have used discounted cash flow. Maybe you have used the discounted cash flow to estimate the fair value of that instrument because the instrument does not have any observable market price, or you cannot even find any similar instrument to use. So you are allowed to use other valuation techniques like discounted cash flow. So your fair value can fall into any of these 3 buckets. You can categorize the fair value into any of these 3 buckets. What do we present in the financial statements? An entity shall disclose at a minimum the following information for each class of asset and liability measured at fair value after the initial recognition. So for your financial statement, you need to disclose the following: the fair value measurement at the end of each reporting date. You need to state the fair value of your instrument at the end of each reporting date. And for us, if you are familiar with financial statement, you will see that when you go to the financial risk management section, you will see the fair value amount being disclosed for each category of items or line in the financial statement. Number two, the level of the fair value hierarchy within which the fair value measurements are categorized in their entirety, which is what I've mentioned. How you've categorized it, all your items or financial instruments into level 1, level 2, or level 3 has to be disclosed in the financial statement. Then last point is categorize within the level 2 and level 3 of the fair value hierarchy a description of the valuation techniques and the inputs used in their fair value measurement. If your instrument is in category 2 or 3 and 3, you need to disclose how you have measured the fair value of the financial instruments in your financial statement. It's important that that is disclosed so that the user of the financial statement can understand it. Please, can you hear me? Somebody chatted that you're not hearing me very well. Can I have a yes if you can hear me, please? Okay, 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 thank you. Thank you. All right, thank you. And look, this fair value measurement disclosure is one of the things that a lot of us will meet in our financial statements. Analyzing your fair value and disclosing the hierarchy. A lot of people do not make that disclosure in the financial statement. And we have to be careful, especially if you audit or if you are a public interest entity or you are an auditor and you audit a public interest entity. Please pay attention to it so that you will not play fine if you are a PIE by Financial Reporting Council definition. Any question on IFRS 13? Okay. Let's move to IAS 10, event after reporting. Event after reporting date. Event after reporting date. A moment, please. Apologies, please. Okay. So, event after reporting date, IAS 10. This standard describes what will happen when an entity should adjust its financial statement for event after the reporting date, or you should just disclose it. What does this standard try to address? As preparer of financial statement, one of the things that happen is that after your year has ended, as the accountant, you've worked very hard. On 31st December 2024, you posted on the entry you need to post, you close your book, and you are fine. By January 4, the auditor comes on site, you give the auditor trial balance, and the auditor starts working. Here and there. He's working very hard. And today is 21st. The auditor is preparing that next week, before the end of February, is going to sign off. One of the things that will have happened between that 31st December and today is that you will have gotten more information even about your transaction, the state of the business, as at 31st December 2024. How do you factor that information into the financial statement? You have not signed your account, but you have passed your year-end day of 31st December 2024. So what happened between that day and today, or when you were going to sign the account, how does it affect the financial statement? That is what IAS 10 is dealing with. And there are two types of events that are identified. One is those that provide evidence of conditions that existed at the end of the reporting period. There are those that, look, they tell you more about things that has happened, even as at 31st December 2024. This information just tell you more about those things that has happened. Mark the word. It has happened. It's just that you were not aware. Those things has happened, but you were not aware when you were preparing your financial statement 31st December 2024. And those that are indicative of conditions that arose after the reporting period, those ones that now happen after the reporting period, after the year has ended, that is the second set of information that you may know. Let me repeat it. Two sets of information. Those ones that tell you, you will not know what has happened as at 31st December 2024. You are only getting to know. Those things that already existed, just that you are not aware. Or those things that happen after the 31st December 2024. For those things that, for those information that only provide you with more details about things that has happened, even as at 31st December 2024, they are considered to be adjusting events. We call them adjusting events, which means you need to go and change your number to reflect those things that has happened. Because they've already happened. It's just that you are not aware as the accountant. It means that you need to change your number to reflect those conditions. Whereas those non-adjusting, you do not need to change your number because the event happened subsequent to year end. That's when the event happened. This is very important because from time to time, we will run into some debates on this kind of thing. At a minimum, you need to disclose the following for each category of non-adjusting event after reporting date, the nature of the event, and an estimate of the financial effect on a statement such that an estimate cannot be, or a statement that such an estimate cannot be made. So we are supposed to disclose information about any non-adjusting events that we have and estimate the potential impact on the financial statement. If you cannot measure it, you need to state so in the financial statement. That's basically event after reporting. But let me give us a case study and ask people's opinion, what they think. So as the financial controller, you've prepared your book for 31st December 2024. But yesterday, you got an information that one of your factories was burned on 29 December 2024. Is this information an adjusting or non-adjusting events? I would like us to raise hand. If you want to try, let me repeat it. As the chief finance officer of a company, you got an information yesterday that your factory got burned as at 29 December 2024. Is this an adjusting or non-adjusting event in your financial statement as at 31st December 2024? I can see hands up. Yes, Jacob, please go ahead.
I think it's an adjusting event because it happened within the period of the. It happened within the period of.
Okay. Okay, it's an adjusting event, which is correct. Okay, so thank you. I think I've also gotten another response. Ifeoluwa, do you have any different opinion? If it's not different, then that's fine.
Yes, it's an adjusting event, sir,
Okay,
for
thank
major
you.
two reasons. The first reason is that it provides condition, it provides evidence for condition that like it occurred before 31st of December of 2024. So another thing is that it provides like evidence that an event actually occurred. So it's an adjusting event.
Okay, thank you. Okay, let me ask us another very interesting one. So, well, some of us may be aware of FRS position with respect to excess profit by the bank. Excess profits by the bank in year 2024, and the requirement by FRS that they want to tax them extra for their 31st December 2023 profit, which was made known to all of us in Q1 of that same year, 2024. The bank had excess profit in year 2023, and the FRS decided that they are going to tax those profits in first quarter of year 2024, when they started seeing their result, that the bank have made excess profits. Do you think that is an adjusting event or a non-adjusting event? Now everybody's hand is all quiet. Okay, let's continue. Adebayo, please unmute.
Hello, good evening, sir. And good
Good
evening,
evening.
participants on the call. My name is Adebayo Lawal. From the look of things, the profit was made in 2023. I mean, 2024, rather.
2023.
2023.
Yes.
Okay, the profit was made in 2023, and they became aware in 2024. It means that it's an adjusting event because the tax we apply to the profit for that particular year. That is my understanding.
Okay. Okay. I can see more comments now. Not enough. Okay. I see more comments shown.
Hello, sir.
Yes, please go ahead.
Good evening, sir.
Good evening.
I think the event is a non-adjusting. And the reason for that is according to IS 8.
Yes.
According to IS 8, the way we discussed it the other time, such a situation is it's going to be treated prospectively because it is taxation's differential. So it's supposed to be treated prospectively, and as such, it's a non-adjusting event from my own point of view, anyways. Thank you, sir.
Okay. Jacob, please.
My opinion is a non-adjustable event, but it depends on the situation. One, in the first quarter of 2024, if the company has already prepared the audited financial report and has been approved by the board, what happens? Let's say the in 2024 first quarter,
The financial statement has been approved by the board of directors. That means automatically it becomes a non-adjustable event from my own opinion. But if the report has not been approved in the AGM, I think that is another scenario.
Okay, we're not hearing Jacob very well, but I heard some of his comments. Okay, so I mean, this is a very tricky one, because where do we add issues if we follow that story, and especially if we follow the analysis? By law, you cannot backdate tax law, which that was the first fight that happened in the market, because people then react that when I was doing my transaction for year 2023, when I was doing my business, you did not tell me that you will tax me excess profits. So the conditions you want to bring to table did not exist. It's a new thing you are introducing that was not there as at 31st December 2023, because there was nothing like excess tax profits. So in fact, it was from a legal perspective, people knocked that issue self off before even go to the accounting, because people fought it back. But practically speaking, let's say they now say, okay, we will not go back, we will do it, it will apply from the day we announce it. Then it will become a non-adjusting. If they were able to force it to all of us as at 31st December 2024, I mean 2023, in their profit for year 2023, then it becomes an adjusting event. But in that case, in fact, it did not say true, because there was serious resistance about it, because people said you cannot change the tax law retrospectively. It's only accountant that apply retrospective. Taxman, tax law, people know they agree retrospective application, because we have done our business based on a particular law. You can't backdate it. Okay, thank you. So I'll move to the next slide, which is employee benefits, IAS 19. The objective of the standard is to prescribe the accounting and disclosure for employee benefits. What do you how do you account for the benefits you give to people that works for you, and the cost you have incurred when people work for you? One is that the entity requires an entity to recognize liability when service has been provided in exchange for employee benefit to be paid in the future. Immediately employees have provided service, you need to recognize a liability because the service has been provided. An expense when the entity consumes the economic benefit. Immediately the benefit is being consumed, you need to expense it, which means once an employee provides service to the organization, you are debiting the expense and crediting liability. And your employee benefit can be in 4 different groupings. You can classify into 4 groups: short-term employee benefits, post-employment benefits, terminal benefit, and other long-term employee benefits. Let's look at them. Short-term employee benefits are benefits other than terminal benefit, which fall due within 12 months after the end of the period in which the employee rendered the latest service. Any benefit that is due to an employee within a period of less than 12 months of doing that service, of providing that service, apart from termination benefit, is considered as short-term employee benefit. Any money that you need to pay an employee for the services they are rendered to the organization within a period of 12 months that is different from terminal benefits is considered to be short-term employee benefits. Such benefits should be recognized as liability after deducting any amount that you have already paid. Whatever is such obligation, you need to recognize it as liability after deducting the amount you have paid. And you also recognize an expense. So you debit your expense and credit employee payable. Debit your expense and credit employee payable. Post-employment benefits are benefits other than terminal benefits, which are payable after completion of your employment. Your post-employment benefit is money you get paid by people after you've served that organization and you are done with your working. So it's like your thank you for coming payment. That one we used to call gratuity. You continue to enjoy it, they will just be paying you, saying, we thank you for working with us when you're a young man. Now that you've served us faithfully and you are now old, please enjoy your post-employment benefit. Enjoy this money from us. That's post-employment benefit. And it can be in two forms: defined contribution plan and defined benefit plan. In defined contribution plan, what you contribute is what you get. What you set aside is what you get. If there is a shortfall, you're on your own. If there is an excess gain, you're on your own. That's defined contribution. It's a contribution under which you are placed a fixed contribution into a separate entity. You put aside a fixed amount as to a fund, and in future it's from that amount that you get paid for whatever happened. That's considered as a defined contribution plan. For defined benefit plan is a post-employment benefit other than defined contribution. Anything that is not defined contribution is defined benefit plan. And the characteristics of a defined benefit plan is that the entity is obligated to pay you an agreed sum based on the defined parameters. You have defined a parameter and the company has agreed to pay you that amount. Maybe even while you are working, that's when they make that agreement that they will pay you those amounts at a later stage of life. Such scheme, when you have such a post-employment benefit, is called defined benefit plan. Nigeria used to have a lot of defined benefit plan, but that has greatly reduced because of IFRS. A lot of people that had defined benefit plans have changed it to defined contribution plan. Any other long-term employee benefit other than post-employment benefit and termination benefit, which does not fall due only within 12 months after the end of the period in which the employee rendered related service, is called other long-term employee benefit. Any benefit that people will get is not within 12 months and is not post-employment benefits and not a terminal benefit, is called other long-term employee benefit. A good example is long service award. If we are going to give an employee long service award, that's other long-term employee benefit, and you need to account for it. So that when the man will reach 30 years of service and you'll be giving him maybe a brand new car for working for 30 years in that organization, it is not the company, the management that are now running the company on that day that will be bearing the burden of that whole liability. So you must be accounting for it as the man is working, because he is serving you with all his useful energy. That's what other long-term employee benefits it entails. That's the car gift is a good example, and a lot of organizations do it. Long service award. Thank you for coming. Let's go to termination benefit. Termination benefit are employee benefit payable as a result of either the entity decision to terminate the employee employment before the normal retirement. You decide to let go of people before the normal retirement, or the fellow decided to also accept voluntary redundancy in exchange for those benefits. All of us heard the story of what happened in CBN last year when some of the employees decided to exit voluntarily on their own because of the incentive. Such benefit you need to pay to those people is considered as termination benefits. Well, somebody is okay. Adebayo say most long-term benefits are not normally planned ahead of time. Well, depending on how mature your organization is, if you are a relatively young business, as people add age, management take decision. But the rule is that from the point when you take decision to run that scheme, that you'll be giving your people those kind of incentive. From that point, you need to start accounting for it. But some organizations are already familiar with it. Like a Julius Berger, for example, if you go and work in Julius Berger, you know that you will receive 15 years long service award. You will receive 30 years long service award. In fact, for 30 years long service award, they will do a full newspaper print and put it to all of you that you've just reached that 30 years milestone. Do you a good picture and publish it to celebrate you for being there for, I think, 30 or 35. I hope I'm not missing it. But that tells us that you can also be aware. For a young company, they won't have taken most of those decisions. It's as the company grew and become successful, say, oh, no, we need to take this decision. We need to reward people and let them get certain benefits for staying this long. But even today's reality, a lot of people are canceling such scheme. Let's look at income taxes. For income taxes, this is not income tax computation standard or law. This just tells us how you account for the income taxes after it has been computed by the tax expert. It doesn't teach about how you compute it. It only teach about how you account for it. And that's why you see said IAS 12 addresses the accounting issues related to tax effect of current period transaction. So you account for how do you treat your current period transaction? How do you account for unused tax losses or credits? If you have tax losses, how do you account for it? And then tax consequences, when kind amount and tax amount different. How do you account for what we call tax consequences? When the amount that the accountant agree to and what the taxman agreed to are not the same. When the taxman says, I don't want like depreciation, I'd rather give you capital allowance, and his capital allowance is not the same as the accountant depreciation. So there is a difference. How do you account for that? That's are the things that IAS 12 deals with. So your current tax liability and asset, your current tax is equal to amount of income tax payable or recoverable on taxable profit or loss for the period. That is the amount of tax that is due on your profit or loss for a year or for a period. After you've done your account and you look at it and compute what is the amount, the CIT, the education tax, the police fund that I need to pay to the federal government, that is your tax payable. If the current taxes payable is greater than tax that you've already paid, you have income tax payable. If the current income tax payable is less than what you have paid, then you have income taxes receivable. Don't ask me a question that, do you get income taxes refund or receivable in Nigeria? Okay. So when you have tax difference, base difference between the accountant and the tax man, it will always give rise to what we call a difference, tax consequences. When there is a difference between the position of the accountant and the tax man, these consequences has to be analyzed into whether it's a temporary consequence or a permanent consequence. A temporary consequence means that we expect that in the future, the accountant and the tax man will ultimately come to the same position and will be happy with themselves. Whereas for what we call permanent difference, the taxman and the accountant will never agree. A good example, if you donate to an unrecognized recognized NGO by FRS, they will disallow it, they will not agree, and forever you will never agree. Whereas if, for example, you have gratuity scheme, so you accrue for your gratuity, debit your expense, and credit your gratuity liability, the taxman will not agree because you have not paid. He will disallow it. However, the day that you pay that liability, the taxman is going to agree. So he's going to allow it. You, the accountant, you will not need to do anything. So you can see the difference because you are the accountant, you have recognized the liability already, but the taxman never agreed. So the day that you finally settle that obligation, the taxman is going to expense it as gratitude expense. If there are tax consequences when the asset is recovered or liability settled, this should be reported on the statement of financial position. So if we have these tax consequences different between the accountant and the taxman, it needs to be recorded in the financial statement as a deferred tax, because we know that ultimately in whatever year the accountant and the taxman are going to come to the same position. So it's considered as the deferred tax and it needs to be recognized in your book. Why a tax consequences? Because kind amount of an asset and liability may differ from their tax amount. I've explained all this. Taxable temporary difference. Taxable income is increased in future when assets recover or liability settle. And then deductible temporary difference. Taxable income is decreased in future when asset recoverability is settled. So once you have this temporary difference, you need to then determine whether you're going to recognize an asset or you are going to recognize a liability. Okay, let's go through it. Tax base of an asset. You have an asset when the amount deductible for tax purpose against the economic benefit received when the asset kind amount is covered is in the future. When you have benefits you are going to recover from the tax man in future, recognize a deferred tax asset. E.g., if you have an unrelieved loss, you have made losses, the tax man is not able to give you benefit, you need to recognize it as an asset. Because we will expect that tomorrow you will start making profit. And when you make profit, you will go back and tell the tax man that there was a time I made a loss. You didn't compensate me for it. Please compensate me now. That will be an asset. Liability is the kind of amount reduced by amount deductible for tax purpose in future when liability is settled. When in future, you need to reduce the kind amount by the amount deductible for tax purpose in the future. That is a liability. So you have an obligation to taxman that in future you are going to meet up those obligations that is due to the taxman because he has not considered those things that you have considered and enjoy the benefits. Deferred tax result from the deductible temporary difference and unused tax losses or credit, relying on every taxable income in future to order for the benefit. One of the things that are required by the standard, if you have these tax consequences, especially an asset, because it's an asset, you are required to demonstrate that you have the capacity to utilize this money in the future. You have the capacity that you're going to make profit, and this profit will be available for utilization by the company in the future. If you cannot demonstrate that you make profit and this profit will be available, then you will may not be able to recognize that tax asset. Your current tax liability is your taxable income times current tax rate, just like what we taught in tax. Current tax asset, if your past tax can be recouped, if you have a tax amount that can be recouped from the past payment, then you need to recognize current tax asset. Example is you have withholding tax. If you have withholding tax, you know that you will recoup it against your future taxes, then you need to recognize an asset. What do we disclose? You disclose information about the deferred tax that is measured. Deferred tax is measured on discounted basis. We don't discount this deferred tax. Even when you think that this your deferred tax is going to reverse in 7 years, that's when we're going to have a taxable profit. You do not discount it. You just recognize it based on an undiscounted amount. Then you need to use the tax rate that you expect when the asset will be recovered. You don't just use any tax rate. What is the tax rate you think will be in place when this your deferred tax asset will be utilized? That's what you need to use. Well, we are lucky our tax rate is very simple, it's stable. It's not like some other environment that their tax rate changes from time to time, and the people are also under pressure to be sure that they'll be able to recoup their deferred tax in the future. So we don't have this problem, but in UK, where, for example, their taxes changes from time to time, you need to be sure that this is your deferred tax. You have used the rate that is likely to be applicable when you want to utilize it. All tax-related changes in recognize current and deferred taxes in profit or loss. Your current and deferred taxes should be recognized in profit or loss, unless they are related to income and expenses that is recognized elsewhere, such as other comprehensive income. The only instance when you will not recognize your current year taxes and deferred tax in your income state, in your statement of profit or loss, if the taxes relate to an item that is recognized in other comprehensive income. Can somebody help us, or maybe chat an example of that case when you will not recognize your deferred tax, your deferred taxes in profit or loss? Rather, you need to recognize it in other comprehensive income. Can people help with example? You can chat, put it in the chat box, such example that you know, when you will not recognize the current taxes or deferred taxes in profit or loss. Rather, we need to recognize it in other comprehensive income. Yes, please. Yes. Okay. No suggestion, no trial. Do you understand my question? If you don't understand my question, let me know. Okay, it seems that the question is thick. So if you have property, plant, and equipment revaluation, and you've recognized revaluation gain, the tax that is due on that revaluation gain will be recognized as deferred tax, pending when the asset is realized. You recognize it as deferred tax, so you will use it to reduce the taxes they are to pay in respect of that instrument. So you are going to book it ahead. You are going to recognize the fact that, okay, this instrument, this property that has been revalued, I have a gain of 100 million, but you know that you will need to pay capital gain tax of 10%, 10 million. But that gain, okay, maybe no, that's not, you have a PPE you revalue, so you had a gain of 100 million. Immediately that you have that gain, you know that in future when the asset gets sold, you will need to pay government capital gain tax. So now it's time to recognize it, and you are going to recognize that capital gain tax as part of deferred tax. For presentation, the deferred taxes are non-current assets. Please don't make that mistake. The VAT tax is a non-current asset, and you need to disclose it as those. No offsetting of current and the VAT taxes. You cannot offset the two. They have to be disclosed separately. Tax expense includes both current and the VAT taxes. In your tax expenses, you need to report both your current and the VAT taxes together. You do the breakdown, but the two must report ultimately together as one total. You must report separately the major components of the tax expense or income, showing the current tax expense, income, adjustment for tax of other period, the VAT tax expense, income from each type of temporary difference, or change in tax rate or new rate. All of this has to be disclosed in the financial statement. Let me test our understanding. So you are a company as the accountant. The Federal Inland Revenue Authority conducted an audit exercise on your December 2023 financial statement, and they've recognized they raised additional assessment of 10 million, which you had to pay in respect of year 2023. Where are you going to adjust that number? Is it in year 2023 account that you've initially published, or in year 2024, or where? Okay, somebody asked me to explain. Somebody asked me to explain the aspect of reporting all the tax expenses together. I will explain it, but let me see people's response. Year 2024. Why? Why year 2024? Okay, somebody said, okay, let me repeat it. You are an accountant of a company, the CFO, and in year 2024, FRS carried out a bad duty audit on your 2023 financial statement number. And based on the exercise, you were given additional liability of 10 million, which you have settled. How are you going to adjust for this number in 2023 or in 2024 and justify your reason? Okay, Musa Rahim said because it has been published, it should be in year 2024. Yes. Yes, it can be recognized in year 2024. Okay, let me make it the response, the report has been reported and approved. Yes, you can still change your prior year number even where you have reported and approved it, an object, a subject at the AGM. It's only that in current year period, you will restate that comparative. You put it there that the number has changed. And so people can know that you've changed it from what it was before. But the issue here is it should be reported in year 2024. Quite all right. And the reason why it will be reported in year 2024 is because tax is an estimate. So it's a change in the estimate that you made in year 2023 that is happening in year 2024, because you are now have more information to what exactly is your liability as at that period. And so it will be reported in year 2024. We are also to disclose the tax expense recognized directly in equity and in each component of other comprehensive income. Whatever is tax expense you have recognized directly in the equity, you need to be disclosed. We are to put the reconciliation of effective tax rate in the financial statement. A lot of people don't do this. In fact, a lot of people don't know itself. Not today that they don't do it. Part of what is required by the standard is a reconciliation of your tax rate. Why it is not 32%. We are meant to do a reconciliation, a very brief summarized reconciliation showing, okay, it should have been 32%. This is the reason why it's not 32%, and this is our closing balance of what it is. That is an effective tax reconciliation. It provides an explanation for you to be able to understand why the tax rate, the effective tax rate of that company is not the statutory rate that as promulgated in law or regulations, because of some other adjustments that are usually made. So we are meant to do that analysis so that people can be able to relate and say, okay, so this is because we have this volume of items that are disallowed. Question. I think I've dealt with. Okay, I think I've dealt with that other question. For your statement of cash flow, IAS 7, the objective is to provide a statement to help investor assess the prospect of future cash flow. It's just for you to be able to assess your cash flow and what you think it will be in the future, and to confirm or change their past expectation, so that when you are looking at the financial statement, you have an idea of what has been the cash flow performance of this business. And it provides information on your operating, investing, and financing cash flow and how its cash balances have changed in the world. It gives information about your cash flow, your operating, investing, and financing cash flows, how it has been changing over time, so that you can understand it when you are reviewing the financial statement. Your cash flow activities is grouped into, they are grouped into 5 groups. They are grouped into 4 groups. Maybe before that is, you have the cash and cash equivalents, which are short-term, less than 90-day, highly liquid investment, help to meet cash flow commitment. So when you are preparing a cash flow statement of cash flow, not cash flow statement, you need to know the definition of the cash and cash equivalent, which are short-term instrument of a 90 days maturity. Then your cash flow is classified into these 4 groups, operating into 3 groups: operating, financing, and investing. So for operating, this is the activity that has to do with day-to-day activities of the business, the core mandate of the business, day-to-day operating of it. That's your operating cash flow activity. Whereas investing cash flow include investment in subsidiary, asset purchase, building, all of this is an example of investing activity. Then financing activities talk about the source of capital, like share capital issue, advances and repayment. All of these are examples of financing cash flow activity. Key requirement is that we need to document foreign currency cash flow, showing at an exchange rate of the cash flow. You need to show the foreign currency cash flow. If you actually have foreign currency, it needs to be shown in your cash flow to show that this money came from foreign currency. The interest and dividend cash flow must be separately shown. You need to show your interest received or interest paid, dividend received or dividend paid separately in your cash flow statement, in your statement of cash flow. Income tax cash flow must be shown separately under the operating activities. We also need to show it separately. For associate accounted for under the equity method, only cash flow between the investor and investee are included. If you are doing equity method for financial for associate investment, only the cash flow that happen between the investor and the investee are included in that arrangement. You do not include things like advances and dividend in the group account because it's within the same group. Non-cash item must be excluded. Any item that is not cash related must be excluded. Restricted cash must be disclosed. If they have restricted cash, we need to disclose it. Two methods are possible, direct and indirect. A lot of people using direct method because that's more of a mathematical arrangement and doing movement in number. But direct method is better. And I've seen people trying to do direct method. They always complain about the complexity of that method because you need to have the details of your bank transaction to be able to do direct method. Indirect method, you just do plus or minus, but that indirect method is very dangerous because sometimes you just net off figures and your cash flow balance, but the disclosure is not adequate. So we must always be careful. Like I mentioned, we must show the operating, investing, financing on the face of our cash flow. The change in cash account equivalent, you also need to show it. And there must be a reconciliation to change the amount of the statement of financial position. So we must also show that this is how the cash and cash equivalent has changed on the statement of financial position. Let me take this related party disclosure. I think this should be the last standard. And this is a disclosure standard. Essentially, it talks about what you need to disclose. And first is that who is related. A party is related if you are directly or indirectly through one or more intermediates, the party. If you have either directly or indirectly through one or more intermediaries, the party is controlled or is controlled by or is under a common control. Let me break down in big English. A party is related if one, you are under the same control, so you have one common group that is controlling two of you. Or two is controlled by, you are being controlled by someone, then you are also a related party to that fellow. You are under common control, so you are owned by the same director, then you are also considered as a related party. If you have significant interest over another entity, you have more than 20% shareholding in another entity, then that entity is also considered a related party to you. If you're a joint owner of an entity, then you're also considered to be a related party. So let's go to point E. The party is a close member. Anybody that is a close member of a key, point D. The party is a member of the key management personnel of the entity or its parent. If we are a member of key management personnel of an organization, key management personnel are people that have responsibility for formulating the financial and operating policy of that business. People that set the tone, people that guide the affair of that entity, they are considered as key management personnel. If you are a close family member, you are their wives, you are their spousal equivalent, you are their children, you are also considered to be a related party. If the point F, if all of these people, they have a company that they control, where they exercise control or influence, then that entity is also considered as a related party. What do we need to disclose? We need to disclose the name of the parent, the ultimate controlling interest. If neither of the above produced financial statements are available, the name of the next most senior parent. So we need to disclose the name of everybody that is in that group structure so that the user of the financial statement can understand it. For the management compensation, you need to disclose the short-term employee benefit, the post-employment benefit, other long-term benefits, termination benefit, and share-based payments benefit. That has to be disclosed. If there's any benefit you are earning as a key management personnel in the company, that needs to be disclosed. And I know this is one of the disclosures that people don't like to make. They don't want people to know how much they earn, but that is required to be disclosed. And things that we also need to disclose is For this related party, we need to state the amount of transaction we have with them, state the outstanding balance, state the provision for debt if there is any that has been made in that regard. That has to be disclosed in the financial statement. Who should make separate disclosure? Every parent of a group should make separate disclosure. Entity with joint control, you need to make disclosure. Subsidiaries, associates, joint venture, key management personnel, and other related parties, all of this needs to make disclosure. Example of related party transaction: purchase or sales of goods, lease, loans, guarantees, etc. All of these are example. So I take question. Any question, please? Any question, please? Any question? Okay. If there's no question, there's no question. There's no question. Just a moment, please. If there's no question, I want to thank all of you. Honestly, I want to thank. Okay, somebody asked, is the VAT tax in other comprehensive income compulsory? Yes, once an item is an item that you've a gain or loss that you've recognized in other comprehensive income, and it's an item that ultimately, when it gets realized, is going to attract tax, then you need to recognize the tax element. In fact, it will attract tax because that's why it's the VAT tax ab initio. So you need to recognize the VAT tax in that regard. Okay, thank you. I will like to stop, but before we close for the day, I want to do one or two things just briefly, just in 2 minutes. I want to, for those of us that wouldn't start, I just realized that sometimes I've not even been taking time to also introduce ourselves to you as a business. PML Professional Services is an accounting firm, and we specialize in anything that has to do with audit, tax, advisory, and socialized software. Please, if you need anything in this regard, feel free to reach out to us. But before I shut down, I think I'd like to have one volunteer. I'd like one person to volunteer to appreciate the team that put this together. Yes, not just me. It's not just about me. It's about the team that I've worked in the background. You've never seen a couple of them because they didn't need to do this. They didn't need to show face, but they are the one that make this thing to happen, starting from even the marketing team that also feel that we should push it out. They ensure that all of you saw the flyer, you all get into the room. So I'd like to have one volunteer to do that appreciation to our team that made it to happen. Volunteer, please. Okay. It seems like nobody is willing to volunteer to. Okay. We've taken a chat. We'll have a chat from somebody. Okay, Samuel. Samuel, please unmute yourself.
Good evening, sir.
Good evening.
Okay, I just want to thank you for this wonderful, 4 classes you have organized. I think to some extent, though you call it refresher classes, but of course, we really gained a lot in the last 4 weeks that the classes have commenced. And we cannot say anything than to say, may the good Lord continue to bless you, bless your team, bless your organization. And my prayer for you at the same time is that the reason why this is being set up, may God make it happen. As in, I know that it's a reason. You must have a reason for setting up this kind of wonderful, devoting your time for these wonderful classes. And I pray that the reason why this is happening, God Almighty will definitely reward you for it by the special grace of God. We really thank you. And on behalf of other members and those that are, both those that are here and those that are not online, I say thank you, and may God
All right.
keep blessing you and your organization.
Thank you. Thank you so much, Samuel. That is appreciated. I will do something. I think I will, let me see if I can unmute everybody. We'll just give ourselves a round of applause, and then we'll shut down we'll shut down I think all of us can unmute for the first time. Okay, so what I want us to do is just to, can we give ourselves a round of applause for 4 weeks? Some of us have attended the 4 sessions.
Thank you, sir. We appreciate that.
Thank you.
Thank you so much. May God bless you and bless your team.
So grateful for
Thank you. We're very grateful.
Thank you all.
Thank you. Thank
So
you.
that closes it. I'm sure we'll do something else next year. We'll do this from
Thank you very much, sir.
Better.
So thank you all for coming. So that brings the refresher course to a close for this year. Thank you, thank you.
Thank you
so
much.
Thank you all. Thank you all, and have a very good evening. And see us another time.
Good
Thank you,
night.
sir.
Good night.